Hi, this is Mohan Kumar from Brainy Bulls, and I welcome you to another episode of Nifty chart analysis using the Triple Threat Intraday Strategy. And in this video, let's look at the Nifty chart for May 16th, 2023, and see what kind of entry and exit signals the strategy would have triggered. Let's have a quick look at the charts. Great. You're looking at the two view chart in the trading view platform. So we have the Nifty spot on the left, Nifty futures on the right, and both these charts are set to a 3 minute time frame. And I have three indicators placed on both of these charts. And these indicators are custom indicators which are built exclusively to be used on the Nifty 3 minute charts. So before I bring these indicators on, let's have a quick look at the price action for May 16th. As you could see, the price almost had a flat open, right? And then it actually showed some kind of bearishness. Then it actually moved back again to the same high right here, and then it started moving lower than the morning's range, right? As you could see, we usually derive the morning range, which is between 9:15 and 10 o'clock, right? Which is right here, the high and the low. And the price went even way past the morning, and there was a huge consolidation you know around noon, as you could see. And then post this consolidation, all right, which is around this morning range is low, the price actually made a firm fall, right? So that was the price action. Now let's apply the indicators and see, what kind of entry and exit signals the indicators would have given in conjunction with the price action patterns and the candlestick patterns. All right, let me quickly apply these indicators. And so the three indicators which I have been discussing in all the previous videos are the locations or the price levels, right? The market participation, which are represented by the black, blue, and green dots, and the trend meter, right? Which indicates the strength of the trend. So we could actually derive the direction uh, of the market based on the trend meter. Okay. So now look at the same chart, right? Now we do not trade between 9:15 and 9:45. We only take trades post 9:45, and the same chart with these indicators applied will now give us a lot of meaning, right? It's going to give us a lot of no, it's going to justify as to why we need to enter into a long trade, versus a short trade, or vice versa, right? So let's have a quick look. So the price had a flat open. As you could see, all the moving averages are kind of mixed up at open, right? The price is slightly above a major location, which is a central pivot range indicated by this orange, lines, and the blue lines, right? This band is the central pivot range band, right? And the price actually started to move further below the central pivot range. As you could see, in this case, the central pivot range acted as a good support, but we do not enter into a trade because it is before our entry time, which is 9:45 is the time that we would actually start getting into trades. But this is way before 9:45. So the reason why we do not enter into trades before 9:45 is the market tends to be quite volatile, right? And we cannot understand the direction of the market, during the first 30 minutes or so. Hence, we simply observe the price action between 9:15 and 9:45. So, after it took a firm support, no, we do not enter into a long because no, for two reasons. One, it is not on the set time, the execution time, which is now post 9:45 and before 2:45, right? So, and the second is, like, you could see all the moving averages. The price is way below the moving averages, and to steer past through the moving averages, it's not something that's likely. So we need to wait for further price action to confirm. So we do not enter into a long trade right here. So when we observe the market, now look at here, in this case it moved below the central pivot range, then it moved back to the sliding, the moving average, right? In this case it is sliding downwards, right? And as you could see, the price action right here, it is showing bearishness when the price actually came back to the same level, which is the morning range high, correct? As you could see, and so this exactly is the pattern that we would usually look at. We've been talking about this pattern quite a lot in the recent times. This is the evening star pattern: a bullish candle, a doji candle, and then a bearish candle. So this is a beautiful setup. So you always actually take a trade against this bearish candle, if it is going to be a short position, right? So the high of this candle, let me clear these drawings. So this candle is what I'm talking about. The high of this red candle is going to be a stop loss, and the low of this candle is going to be an entry. And you want to stick to the trade. Look at the trend meter, right? I mean, this is also an important aspect. The trend meter is almost close to the red zone, and it's a very good location, right? The morning range high, right? And the sliding moving average acts as a proper resistance. And look at the trend meter, right? It is close to the red zone, right? In this case as well, it's almost close to the red zone. So considering the price action for the day, the moving averages, so it's a very good trade to be taken on the short side. So it's a wonderful trade. You stick to the trade as long as the price is at moves to a key location. In this case, it is a central pivot range, or the trend meter gets into the green zone, right? Or if the if okay, and if there is a huge participation, right, coming around these locations. So in this case, as you could see, when the price moved towards the central pivot range where exactly it took support in the morning, right? And of course we know for a fact that the price is going to react. So the price did react. So as an aggressive trader, right, we always book up profits when the price is at a major location. And even though the trend meter was not at into the green zone, there could be a follow through trade that's called the trend continuation. So we book profits, we re-enter into the trade, the same trade, right? As a follow through move when the price moves back into the moving averages and then shows some kind of candle patterns. In this case, you could see there is a strong pin candle and there is a then a red candle which confirms that the price is having more momentum to the downside. Like as indicated by the trend meter, it is yet to get into the green zone. So we get into a follow-up trade right here, and we capture this move as well. Okay, see a wonderful move right here, which actually confirms, that the trend to the downside is quite obvious. And in this case, the price and the trend meter moved into the green zone, and you could see there is a stiff participation coming up here. There is a volume candle, which is like a hammer candle. This exactly is the place where you would take your profits. So two good trades in the morning. So one was this, right? You booked your profits right here because it's a major location. Another follow-up trade in the same direction as the first one, the first trade, another follow-up trade. So two beautiful trades back to back, right? So these two trades. Now let's observe the price action. Um, so the price actually after moving below the central pivot range on the futures chart, and anyways, the price is below the morning range on the spot chart, and you could see a bit of a consolidation right here, right in the spot chart. It's very clear it has been consolidating. And on this particular chart, you could see the price has been slightly moving higher towards back into the moving averages and towards the black moving average, which is the major one. And as you could see, when the price moved towards or into the moving average band, it got a stiff resistance right here, right, as you could see, and a stiff resistance right here below the CPR. And look at the candle patterns right at these levels, a beautiful hammer candle with a lot of participation. And look at the trend meter, right? It is almost close to the red zone and has been consolidating around this region. A wonderful trade again to the downside. You enter with a stop loss right above this candle and entry right below this candle, and you stick to the trade as long as the price, the trend meter gets into the green zone, right, or the price is at a major location. So in this case, this could act as a stiff, support. So you take profits right here, right? Maybe 50% of the lots you would square off, or you would get to square off everything, right? And then you can take a follow-up trade when the price catches up back to the EMA, right, which we have been discussing in most of our videos, right? How the price retraces back to the moving averages. In this case, the price breaching through all these moving averages and getting past through CPR is an unlikely scenario. So we do not enter into a long trade, but rather we take the follow through trade, which is right here. So this exactly is how we analyze the price action, and in conjunction to the indicators, we execute trades, right? Limited stop loss and an unlimited target, right? That's exactly how we trade. So if you like the video, if you like what you're seeing, please do like this content. And if you are interested to learn more about the strategy, please do contact me at my WhatsApp or email ID. Until I get back to you with another video, it's bye from me. Thank you.